Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on our favorite, the Primary Vision Frac Spread Count show, we're going to go through what does U.S. activity look like, how has the physical market changed a bit, and then we're going to go into some of the recent U.S. data. Now, just to give you that high level, just looking at some of the summaries in terms of what we're going to look at, as we've been talking about, U.S. completion activity, leveled off a bit as we came into the end of June. We expect to see an acceleration as we go into July. Just as we saw some big ramp ups last week, and then we expect that to continue as we go into the first the next 4 to 6 weeks. Then when we look at the international market, we're going to look at Angola, China. What are some of these changes that we've seen, and some of the spreads that have opened up, just because refiners continue to struggle on a global level, especially when you start looking at crack spreads and just this glut of diesel that is really struggling to find a home. Then we're going to round it out and talk about what are some of the recent U.S. data points, looking at inflation, consumer sentiment, and then what are some of the expectations going forward. So as we look at what has come out, last week we were at 235, and this week we're at 232. So we went down by 3 frac spreads, but 2 of those frac spreads were in 2 smaller basins, some of those fringe basins, and then 1 was just in the Permian. So again, when we talk about the frac spreads, this is active spreads. So this is something where that spread could have gone down, moved to go to a new location, then turn back on. So again, a lot of this is transitory in terms of, and actually transitory, not in Fed speak, but actually just measured in a week or two. So when we look at some of the things when we're talking about spread counts, as we said at the beginning of the month and at the end of last month, was that we were going to see close out between that 230, 235 level as we got into June, and now we expect to see a little bit of an acceleration as we go into July. But remember, those additions are going to be much slower. The Permian is right near full capacity. There's maybe a little bit more that can be done, but anything additional is going to require new equipment, whether it be repaired equipment, new pieces to the equipment, and most importantly, new labor. And that is, I think, the biggest component that we keep harping on. The area that we think is going to get more activity, and in our insights this week, we did this big deep dive on NGL pricing. Where is it? Where do we think it's going to go? And how does naphtha or condensate pricing start to play into that as we see a growing glut of condensate? Just because when you go internationally, petchems have optionality when you look at the flexibility of what they're going to run as a feedstock. So we think that, but we think there's going to be some activity in the Anadarko. The Williston's going to continue to move up. So again, all things are pretty much steady state. We still have, most of these are geared towards oil. And for clients, we show the oil to gas split. So then when we look at just the last 3 months, you can see that steady move up. From as of March, where we were at 182. Got to about 235 as that peak, and then we're going to continue to work our way up. And what we think is going to be closer to the top is about 270, 275 spreads as we go into really August, as we get this little bit of ramp up, and then we start to go sideways from there, just because there's a bigger target for oil right now, really not focusing on natural gas. So again, the splits are very different when you start breaking it down by basins, because a lot of the recent activity has been focused on and geared towards oil. So while we've been talking about those rigs coming back, we've started to see it last week and the week before. Obviously you can't bring back 10, 10, 10. It's something where it's going to be 10, then another 10, and you're just going to start to see a steady increase after this 1 week pause. Then when we look at going back to 2021, 2020, you can just see obviously where we were at that peak, and now we started to come up through that trough. On a seasonality level, we've flattened out a bit, and we think that that's going to start to accelerate, but it's just a matter of getting people in place. And I think the most important piece really remains labor, because as we said in the EIA show, there are 6 states that are reporting some gasoline outages, and it's not because there isn't gasoline available. It's that there aren't drivers or truck drivers to take it from point A to point B, because we continue to see a lot of these difficulties in the labor market, some of which we're going to talk about. I did a short thread on it on Twitter, but then we did a big deep dive on employment, jobs, unemployment, wages in this week's insights. So now when we look at the loading schedules, we always come back to this just because it's a good kind of testament of where things have slipped out. So you can see when you look at Nigeria, we've seen deferrals now coming out of July going into August. And I think more importantly right now is Angola, because in my 15 plus year career of trading physical paper, commodities, it's very rare to see Angola not sell cargoes ahead of the actual loading month. So when we look at July, there are still cargoes sitting there waiting to be sold for Angola. Now, West Africa has picked up a bit, which is what we were saying was going to happen in the EIA show, just because the U.S. is becoming a bigger pull on some of these cargoes because the U.S. is starting to ramp up as we look at WTI versus Dubai spreads, Magellan East Houston versus WTI spreads. All of these things are starting to shift where it actually makes sense to go the opposite way from the coast to Cushing. And when you look at just the spreads in general in terms of Brent, WTI versus Dubai, West Africa versus Dubai, the Middle East continues to win out when you look at just where you're going to choose to buy from. But Nigeria cut some prices. That has accelerated some of those movements. And now they're talking about cutting August. But when you look at the slippage, as we've been having in Nigeria, I think when you look at what they've actually cut, it's because they expect more to slip out of July into August, and they're making room for that. So Russia started to add. Russia's been trying to cut a bit, but at the same time, we actually had Urals come in at about a 15 to 30 cent discount versus previous offer. And that's, previous bid, and that's when we're starting to see things cross about 15 to 25 cents cheaper. And this is what we had said. Everyone saw these spreads spike, so why not just throw an offer out there, see if you can get them to come higher, and then if you can't, then you start walking back what you're willing to accept. And we've started to see that over time. So when we just break it down for Nigeria is yet to sell 5 out of the 49 planned in July, so that has sped up a bit. When you look at where things are going, drops from 13 from 20. Nigerian differentials have gained thanks to better demand from Europe and the U.S. So we saw a little bit of a dip that started to bring guys back. Angola is yet to sell 6 to 7 of the planned 32, which is actually unchanged from June 17th, which is very odd for this time of year, especially when you start looking at China and what is happening within Asia. And we'll talk a bit more about what we're seeing on that level of activity. Then when we look at Congo, there's still 2 cargoes, which again, speaking to some of the weakness out of Asia. But then, we'll talk about the teapot refiners and what that means for overall flows. Then when we look at India's Maharashtra, I'm terrible at pronunciation, so I apologize. Where Mumbai is located, the second most populous state within India, they have actually reversed some of their recent COVID restrictions due to some areas that are seeing some of this Delta variant move about. So again, there's some restrictions in terms of movements. Just it's not so much they're going backwards, it's just they're stopping the reopening just to make sure that things are moving at a steady pace. But we don't see that really adjusting what we're seeing in terms of activity levels, because they were already diminished. They've come back a bit, and we expected them to level off, given at this level. And this just, again, kind of par for the course. Then when we look at Colombia, which is interesting because Castilla fetched the deepest discount this year as China, the main buyer of the grade, is favoring Dubai-linked barrels, which again, Dubai has been moving itself back in as we do have the Middle East putting more barrels on the water, just given when we look at the OPEC deal and the additional barrels that are already coming back. So then when we look at the Middle East marker of Dubai is trading at a discount of $3.99 to Brent, up from the discount of $1.76 in March, making Dubai-linked oils more competitive versus Brent. And then demand from the U.S. helped to lessen the hit. Gulf refiners stepped up purchases with summer fuel demand and ahead of maintenance in Canada. So we've seen the U.S. again continue to be some of the bigger driver as we see that shift from light sweet to heavy sour, just because if you want to operate, especially in the U.S., and see those refinery runs increase, you have to have that heavier cut. But it's important to appreciate where things sit right now, because the U.S. did shut down 5 refiners, or slated 5 refiners for shutdown, just after what happened during COVID, just the lack of I should say the overcapacity that has been coming into the market. We talked about it before in terms of the mega sites coming on, the blend of refining petchem. And this is something that BNEF put together looking at global net capacity additions versus demand. When you look at just the capacity that has been coming on and what the forecast utilization rates are. And this is where we start getting into the teapot refiners, because as we've talked about, the China has cut import quotas for teapots by 35%. And they've also impacted by increasing the levies on light cycle oil or semi-refined crude, which was used to create low-quality diesel. And a lot of that was coming from Singapore, Japan, and South Korea. So now you have the imports coming down in terms of import quotas. We expect the SOEs to make up some of that, so there shouldn't be too much of a shift. But if you think about the SOEs competing against the teapots, that would have just increased total imports into China. Instead, we're only going to get one side of it. So that's going to be a bit of a hit to the import expectations. But you're also going to have a lack of imports coming into the country for semi-finished products, which means that these refiners are either going to have to find other places to sell that product, or they're going to have to cut runs themselves, again, reducing the amount of crude that is underlying demand. And some of the political backdrops, and next week we're going to do a deep dive into Myanmar and why this is so important just for stability in the region, because there could be some knock-on effects. But a big knock-on effect. Taiwan and the U.S. are meeting next week for the Trade and Investment Framework Agreement talks, or TIFA, between the U.S. and Taiwan to find the best way to go forward to increase our trade, deepen trade ties. This was kind of put on the back burner when President Trump started with the trade war with China. That was a bigger focal point. Now that things continue to go that route, as the U.S. just sanctioned another 5 areas in Xinjiang for human rights violations, that is only expanding. Now we are going to deepen our ties with Taiwan. So looking at that as well, because when you look at what the U.S. has done, we're shutting down refineries, especially in PADD 5. Where are we going to maybe get some of this excess product? Well, it would come from China, or maybe some of the other countries that are no longer selling into China. It's important to consider where a lot of these global refiner closures are going to come from. And the one thing that we've been talking about, it's really going to be a large part of Asia and North America, and to a smaller extent Europe, just because Europe was one of the first ones to see some of those shuttering. There is some union backdrop and some protection on some of those assets. But North America and Asia ex-China, because China is the one bringing it on. Middle East is bringing on some new capacity. So some of these other Asian nations are going to have to say, look, does it make sense to keep this operational, or will we just import more from China? Which, again, is just going to shift the way crude and products is going to move, because there is a huge glut of diesel that we've been talking about. And now Vortexa is giving some data on that backdrop, which we'll talk about in a minute. So then when we start looking at some of the shifts in Singapore, when we look at some of the storage, again, we'll do a deeper dive on the EIA show. But you can see middle distillate had a small build, light distillate had a small draw, and resid had a steady draw as well. Those are things that, again, there's some timing within that. They're still at an elevated level. And as we said last on the EIA show, is going to be kind of the sideways move. We're going to get some drawdowns, some builds. And this is another one where there's a significant amount of diesel floating around. And now we're seeing Europe starting to absorb some from others, cutting from other flows. And we'll go through some of those flow impacts. And the reason why is when we start looking at Europe, because you can see that there were builds across the board. When we look at European products, gasoline is back to a low. That is going to start to reverse just because the arbitrage between the Europe and the U.S. is closed for the most part. So a lot of these flows are going to slow down. As we talked about, there's still enough residual to keep us elevated on the gasoline import side, but those will start to whittle down to something a bit more normal when we look back. And then when we look at some of the flows into Asia, into Europe, We actually have a decent cut of naphtha, which is a semi-blended because it has some gasoline in it, is actually going to go, instead of going to Latin America and Asia because they're glutted with some naphtha, a lot of this is getting kicked over into Europe, and you're going to see that get cracked and adjusted to create some more gasoline. So then when we look at some of the flows, transatlantic fuels to Europe are poised to jump 912,000 tons aboard 23 tankers, the highest since October. And that compares just with 608,000 in May, according to the tanker tracker. European imports, so that's coming from the U.S. And then when European imports of refined products from the Middle East, comprised mostly of middle distillates, are going to slip in June to the lowest in 3 months. Remember, we had that huge surge, which has shown up in gas oil and fuel oil, which they're going to, especially the fuel oil side, they'll start to recrack that to create gasoline and some other products. But they did get a big bump from Saudi. It's just they had a big cut from Qatari. So you had essentially this just evening out for the most part in terms of where some of these cargoes were coming from. So that's going to continue to adjust, because that's why when we look at Fujairah, when we look at what's come from the Asia, when we look at Singapore and some of these flows, that's where we're going to get some of these shifts in general. A lot of this is still making its way into the Atlantic Basin. It's going to compete as to does it go to Europe or the U.S., because we do have that floating amount of distillate, which we'll talk about in a second. So here's where we look at China Shandong weekly stocks. So you can see that they're at the lower end of 2021, but still at a seasonally adjusted all-time high. 2021 has just been this kind of back and forth just in terms of some of the dynamics. But I think it's important to talk briefly about what some of the storage is throughout the country. Again, it's by satellite. Who knows if it's right? It's just a matter of getting some of these guesstimates of where things are, because there's an expectation that there's about 1.3 billion barrels of storage capacity in China, just to kind of put that benchmark out there. So when we look at June 22nd, 2021, when you look at, now this is coming from Kairos. So Kairos has said that as of June 22nd, there's 974 million barrels in storage. In June 2020, there were 973 million barrels. So over a year's time, and there's a 1 million barrel increase in that time frame. Now, they started out 2021, according to them, at 1.01 billion barrels. So over 6 months, they've pulled down 43 million or so. But just to consider where they were, January 2020, so right before they got into a steeper lockdown, they were at 860 million. So just to put into context on how elevated they still remain, and now they're going to cut imports, they're going to, SOEs are going to pull a bit more. They're starting to adjust some of these flows, which should start to drain some of this closer to what they were on a pre-COVID level. But again, there's still a significant amount. I mean, you're talking about almost 110 million barrels that can come out just to get back to some sort of normalcy. And they've only done this doesn't even include the 43 they've already taken out. So again, that just to give you an idea of how much work there has to be. Now, looking at it a little bit differently, now this is coming from Ursa Space Systems. So China's crude inventories fell to 934.8 million barrels, according to them, as of June 24th, which is the lowest since early Feb. Now, inventories began to fall from mid-April and are currently 6% lower than their record high of 991 million in October of 2020. So just to give you an idea of kind of where they're sitting, stockpiles peaked this year. Now, so we're looking at this year. So this year we were at 958. Now, according to them, we're at 934. So you're talking about a draw of about 24 million, just to kind of give you where we sit. But they got to 924 million barrels on February 4th. So we actually had an increase, according to Ursa, from that time period. And it's important, again, to always think about seasonality, because seasonality, you have Golden Week, you have a increase through May. You typically see some drawdowns. So to actually see builds and some excess remaining in the system still remains concerning when you think about China's already supposed to be back to normal, which is why we always talk about, credit impulses, why we look at new exports, new imports. There's a lot of problems that still persist within the Chinese system. Now looking at fuel oil, fuel oil had a big spike in storage. This is something that they're going to actually increase the amount of available export quotas coming into the market just because they're coming up to the peak. And when you look at the global diesel, so now Vortex has said that global diesel demand centers may not be able to absorb the current wave of seaborne shipments, with flows this month poised to hit a record high above 8 million barrels a day. Flows set for second straight month above respective 2019 levels. In a potential rerun of March, high exports may increasingly put pressure on global diesel cracks and ultimately refining margins, which we've already seen as this glut of floating product tries to find a home, which again, when we talk about oil, we always have to talk about the refined product side because they're the same, they're two sides of the same coin. And that's why we have to look at, okay, well, how hard are you going to run if you can pull down some of this diesel? Where is gasoline right now? Gasoline remains elevated in the US, in other regions. What does that look like as we continue to see some of this struggle in terms of just flows? Flows going to South and Central America to meet seasonal demand, while important dynamics in Europe and Asia have been stable. Combination of residential, ag, and power generation demand is driving increased flows to LATAM. But when you start looking into Asia, you continue to see some of these slowdowns where exports from India, the Middle East, Mediterranean, U.S. PADD 3 continue to rise. Chinese shipments appear to be on the declining trend because remember, China's starting to adjust. So we continue to see some of these big behemoths, especially India and the Middle East, kicking out all this excess disti, which is going to end up either, as we've been saying in the EIA show, it's either going to, we're assuming about 50% in storage and the remaining finding its way into the global market. So now when we look at some of the impacts into the U.S. and what we've been seeing in general, the personal income dipped. It's important to look at it against expectations. So personal income came in at -2% versus the survey of -2.5%. Personal spending missed estimates coming in at no change. Real personal spending came in at -0.4% versus the estimate of -0.1%. But then when we look at inflation, which is the PC deflator, which is what the Fed typically likes to focus on, it still remains high. It came in below estimates. The month over month was expected at 0.5, came in at 0.4. Year over year, right along the lines of expectations, with the core deflator coming in instead of at 0.6, at 0.5. But then when we look at the University of Michigan sentiment, you can see that it slowed down from last month, and it's also gotten worse versus the survey in terms of what the expectations were. Sentiment declined, current conditions declined, expectations fairly flattish, but then the one-year inflation started to creep higher, which we've continued to see, which we'll talk about in a minute. Now, we are getting that shift, as we've been talking about, with the decline of purchases of durables. When we look at durable goods, that continues to come down as we see this pickup in services, which we'll talk about a bit more in a minute. But you can see that there's been that stark contrast in terms of those adjustments, which is going to be a continuation where services are going to get more expensive. Some of these durable goods are going to see some of their prices moderate. But again, it's just going to be a flip. Now, it won't be equal. Like, the services won't get as expensive as some of these durables coming down, which is where we start getting into kind of this, this peaking of prices, but really not a big fall, just a sideways move on a stagnation component. So then when we look at retail mobility, the U.S. has continued to see and been driving higher, while we've seen a rollover in a lot of other regions, which again is coming to some of the spread of the Delta variant, some individuals just taking a pause after seeing a strong recovery off the bottom. And these are some of those things to consider when we're looking at global demand. Where is that going to look as the USDA, and I tweeted it, but I unfortunately forgot to put the slide in here, and we'll talk about it next week. We've actually seen an increase. They've taken up food inflation expectations in terms of where they see things. They took it up by about 1% across the board, or I should say from 2.5 to 3, 3.5 to 3.5, 3 to 3.5. Kind of just moving up in terms of what we're seeing. Then just to show a quick backdrop of kind of where we sit, we obviously had the big increase on the government transfers. That has since abated. We do have the infrastructure bill, which is about $1 trillion. which, to be fair, has started to alienate some of the fringes, which is a good thing. We need to become more centrist in terms of our exposures. I'm tired of, the left going to, trying to appease the far left and the right trying to appease the far right. It's time to get serious about how are we going to address, these real issues across an infrastructure side especially when we're talking about roads, bridges, and special projects. Unfortunately, $109 billion. Maybe that covers New York, it's just based on cost, but at least it's a movement in the right direction. And some of that pork has gotten shaken out, which I think is a positive, because we really need to start getting serious about seeing some long-term benefits of this investments. And I should say this stimulus that continues to get pushed into the market. This is just showing the inflation when we start looking at the different PCE, where these inflation remains. And this is what we're talking about on this elevated level, just staying in this kind of base component of 0.3 to 0.7%. And as you kind of see it waffle back and forth, and that's where, when you start looking at where's the base effect, and then when you start seeing about, okay, well, what happens when the base effect pulls away, which is why we talk about the 3 month rolling average, the 6 month rolling average, because we still see that accelerated movements. And it's interesting because I think this is a good backdrop of where things sit right now when you look at cumulative, annualized, and monthly year to date, and then what we have to see for the rest of the year to hit 3%. So you can just see how we're already well above that essentially where they're saying that we have to be for the cumulative for the rest of the year, and how it is very much doable on a monthly level, just given where we've been printing. So then when you look at the 4% on the monthly side, you can see that we've actually been above even the 4% level. So there will be some moderation, but just based on how things are tracking, we are tracking much closer to 4%, and in my opinion, over 4%, just based on where we sit, where prices are. We keep talking about the supply chain, PPI from abroad, import prices, export prices, shipping, all of these things. And then when we talk about inventories, how low inventories are, we remain price takers. This is going to be something that's going to continue to get passed through to the consumer. Now, understanding the personal income dynamics, you can see where those government transfers are, and just how different things have been in terms of where we sit today, as we're still above that February norm, but again, we're coming much closer, and the next incremental benefits are going to have to come from that compensation and other income, which is just your job, your wages, your benefits, because a lot of this is going to continue to go away. We have June 12th was the first expiration of extended benefits. These are things that are going to continue to happen. That's going to take away some of these transfers, and where we continue to see on the labor side, and some creep in some wages and some declines in others. But again, there's a big backdrop that we go through in our insights. Then when we talk about that shift, when we look at durable goods, non-durable goods, and services, that's where we continue to see this crossover. So net, you're going to see the rotation, spending come closer to zero, but it'll be driven based on durable goods have been bought, services will come back, and we're seeing that moderation in general coming much closer to that kind of flattish number versus February of 2020. And just to put it into perspective on real disposable personal income, when we look at where we are, you can see where the COVID started and the stimulus came in, but we're still above trend, but that's going to moderate very quickly. We're still almost 2% below the spending trend, even though personal income remains about 4% above trend. And that's where it's just a matter of who has the money, how quickly we'll come back into the market. And those are things that we've always discussed on the Econ Show, talking about where are savings, who has the most savings, and then is it something that's going to be sticky and stay in the bank or come back into the market, which is something that we'll talk about again on the Econ Show. So I know we talked through a lot. Always happy to take questions, feedback, always appreciated. We hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.